accrual accounting. We started with it with this section already last week, but we will do a short repetition at the beginning. So do you remember what accrual accounting means and what is the difference to cash accounting? Any idea? So cash accounting is about cash transactions, and there are profits, for example, when cash inflows are larger than cash outflows. But accrual accounting is different. It is a revenue, for example, and is booked when the related transaction occurs, and not when cash is necessarily flowing. So, the thing is that cash accounting is not allowed according to IFRS at all, also according to US GAAP, for example, and that's why we have to use accrual accounting. Yeah, cash accounting is not allowed. There's an exception, of course. In the cash flow statement, it is about cash, but generally we have accrual accounting in the prevalent accounting according to the prevalent accounting standards. So as I already said, accrual accounting shows the impact of the transactions on assets and liability in the periods in which the transactions occur. Yeah, and this is true even if there is no related cash flow in that period. Yeah, so and this is, for example, think about if BMW is selling a car, it records sales revenue, even if the customer has not yet paid. Yeah, so if you think about when is this typically in the case of a consumer product? It's typically when the company hands over the product to the customer. Yeah, so when that is the case, revenue is recognized. Also, the cash is maybe not flowing at that point in time. And you have to deal with accrual accounting because it has to be used according to the accounting rules. Yeah, so it's a must, and you cannot say we do cash accounting instead because we like it more. We and you have to learn accrual accounting. Yeah. So as I said, profit is not determined by cash in and cash outflows, but instead, profit is essentially it's income minus expenses, and income is defined as increases of equity, yeah, excluding transactions with owners, yeah, e.g. additional capital from share owners. So can you think about any other transactions owners. So this is, by the way, this is IPOs here. Yeah, we're talking about IPOs, and we're talking about additional capital from shareholders. But here is, for example, another transaction with shareholders, which is a dividend. Yeah, a dividend is also a transaction with share owners. Or think about a buyback. When a company is buying back shares, this is also a transaction between the company and share owners. Yeah. So income is defined as increases of equity, excluding transactions with owners, and expenses are defined as decreases in equity, excluding transaction with owners. So transactions with owners are excluded in both cases. Yeah, Yang said it correct. Share issuance. Yeah, share issuance is additional capital from shareholders. This is IPOs, and this is a transaction with an owner. Correct. So in accrual accounting, cash and profits are often not the same. Yeah. So, for example, sometimes you have a cash outflow. Also, it is not an expense. Yeah. So part of the profits are used to pay for new assets. This is called capital expenditures. Yeah, we call this capital expenditures. And capital expenditures is a cash outflow, but there is no related expense, yeah, which is booked in the same period, yeah, at least not completely, yeah. Instead, the expense is spread over time, because once you have the assets, once you own it, you depreciate it, yeah. So this is called capital expenditure. By the way, I sent you the slides. I sent you the slides now. This is the new slides. So then we can go on. Another instance where cash flow and profit or expense are not the same is when a firm has sold something but will collect the money later. Yeah, this is called an account receivable. Yeah, this is called an account receivable, and we will later talk about accounts receivable more specifically. Yeah, so when a company has sold something, then the company books the revenue, and there is also an asset. Yeah, and the asset is called account receivable. And later, the money is flowing and the account receivable disappears. The third instance, a firm has paid rent in advance. Yeah, this is also an instance where cash flow, in this case, is cash outflow, and expense is not the same. Yeah, because when the firm has paid rent in advance, then it is not an expense in that period in which the firm has paid the expense. Yeah, instead it's a prepaid expense. It's a prepaid expense, and the prepaid expense is an asset. Yeah. Next is when a firm buys something on account. Yeah, when a firm buys something account, it results in a liability. It's called an account payable. Can you think of anything what a firm typically buys on account? What is typically bought on account? Any idea? What is typically bought on account? For example, inventory. The next instance, a firm has collected money. Account payable, by the way, this is a liability. Yeah, this is a liability. Account receivable. It's an asset. Prepaid expense is also an asset. Why is account receivable an asset? Because the firm has the right to receive the money in the future. Why is prepaid an expense an asset? Because the firm has the right, yeah, it's an asset, the right to use something. Account payable is a liability. Because it's a future outflow of resources. Yeah, that's the liability. And the next one, a firm has collected money in advance of providing service or selling product. Yeah, this is unearned revenue. By the way, did you get my did you get the slides? Yes. Okay. Ray Chan is there. Welcome. That's fine. Ray Chan, are you in Wiesbaden? Okay. Are you in Wiesbaden or are you in China? In China. All right. Which city? Guangzhou. Okay. All right. I just talked to Sue. She's in Wiesbaden. And Liang, where are you? Is Liang here? Also Guangzhou. Okay, all right. So welcome to Guangzhou. We were here. Yeah, a firm has collected money in advance of providing service or selling the product. Yeah, and so this is a liability, and the liability is called unearned revenue or deferred income. Yeah, why? The customer has the right to receive the product or the service, and the company has the obligation. Yeah, the company has the obligation here. This is a liability. Yeah, liability. The customer, the firm has it's an obligation. Firm has the obligation to perform. It's an obligation. Yeah. So here we have two liability and two liabilities. Yeah, here liability, and two assets. Yeah, resulting from accrual accounting. Yeah. Account receivable and a prepaid expense. This is an asset. An account payable and an unearned revenue. These are liabilities. Yeah, these are result in obligations for the firm. Yeah. So and as I said, all firms have to use this accrual accounting because it's a better measure of performance than the cash payments. Yeah, so it's better because actually you want, for example, you want to record revenues when the transaction occurs. Yeah, it is not really it is when the customer gets the product, yeah, and takes the risk and rewards of the product, say a car, this is more necessary, this is more important than when the cash is flowing. Yeah, the customer, we assume that the customer will pay. Yeah, but the really relevant moment for booking the revenue is when the company hands over the product and the risk and rewards that are related to the product to the customer. Yeah. Okay. So let's go on. We have the time period concept. And the time period concept means that firms have to report at regular periods. Yeah, regular periods, and that means at least annually. Yeah, and that's why why the report the companies have to publish every year is called annual report. Yeah, annual report. Sometimes it's more frequently. Yeah, sometimes firms have to report more frequently, and then that is typically a requirement of a stock exchange. Yeah, so then this is often requirement of stock exchange. Of stock exchange. Yeah, for example, when you are when you are listed in the United States, in New York, I know, for example, that companies have to report their quarterly earnings. So this is a stock exchange. The quarterly earnings, and this is a requirement of the stock exchange. We have the revenue recognition concept, and the revenue recognition concept means that revenue is recognized when the revenue is earned. Yeah, so when the revenue is earned. And the really important question is, when is the revenue earned? When is the revenue earned? When the revenue is earned when risk and rewards pass to the buyer. Yeah, this is, for example, think about a car. When the company hands over the car to the buyer, and then the risk and rewards pass, because when there is an accident happening after the company hands over the car to the buyer, then the buyer has the problem and not the car company anymore. So risk and rewards have passed to the buyer after the company handing the car over to the buyer. Yeah, when control changes, yeah, when you hand over the car to the buyer, then the control of the car changes. Yeah, so after the customer has bought the car, yeah, and the ownership has changed, then the control changes. Yeah, so the customer sits in behind the steering wheel and has control over the car. Revenue has to be able to be measured reliably. Yeah, so this is a requirement for revenue to be recognized. It has to be able to be measured reliably. Yeah, you cannot measure it reliably, then you are not allowed to record revenue, and it has to be probable that the economic benefits flow to the firm. Yeah, if that is not the case, you cannot record a revenue. It's not allowed to to record a revenue. And the related costs have to be able to be measured reliably. Yeah. So the related costs have to be able to be measured reliably. We have match concepts. Yeah? In accounting, and match concept means that expenses have to match the revenue and vice versa. And so it's about the connection between revenues and expenses. And when I say expenses have to match revenue, that doesn't mean the magnitude or the amount has to be the same. It means that in timing, they have to match each day in timing. When the revenues are booked, related expenses have to be booked. So, for example, when you think about BMW recognizes revenue for selling its cars. So when a revenue is booked, then the related expense to be booked. What would be related expense in case of BMW? Idea? Any examples of expenses that BMW has? For example, costs of goods sold. Costs of buy spare parts. Exactly, yeah, buy spare parts. This is costs of goods sold, material or spare parts that has to do have to do with the products. Yeah, cost of goods sold. This is anything that goes into the products. Yeah. Okay. So these are exercises. These are examples. A customer pays the firm A 2,000 on March the 15th for a shipment in April. When will the firm A earn the revenue? What do you think? The customer pays in March. The shipment takes place in April. When is the revenue? When is the revenue? When does the revenue take place? Is it in March or is it in April? What do you think? Do you think what is relevant? Is it in March when the money flows, or is it when the shipment takes place? It is when the shipment takes place. So it's not March, but it's April. Why? Before it's unearned revenue, yeah, for the firm. Yeah, the firm gets cash. First here, the firm gets cash. So it debits cash. Debits cash. and it credits unearned revenue. And this revenue is unearned until the shipment takes place, until the company performs the service. Yeah. And when that is the case, then the company debits unearned revenue and credits revenue. Yeah, so does that make sense to you? The company gets the money first on March the 15th. It gets the money, but it has not yet earned the revenue, because this is a shipping company or shipment company. And unless the company hasn't shipped the goods, revenue has not yet been earned. Yeah, so revenue is booked here. Yeah, and this is in April. Yeah. This is in April. Does that make sense to you now? Do you understand why? The company gets the money first, but then it has an obligation. It has an obligation to do the shipping. And when the shipping takes place, then the company actually earns the money. Yeah. Do you understand that now? Yeah. So the second example, a firm pays 4,500 on July the 1st for office rent for the next 3 months. Has firm A occurred an expense on July the 1st? What is it here? In the first example, we talked about it was an unearned revenue. This is a prepaid expense. Yeah, this is a prepaid expense. And the company has not yet incurred an expense on July the 1st. Yeah. Why? Because the company still has the right to use the office. Yeah. So in this case, the company debits the prepaid expense debits the prepaid expense and it credits cash. And later, the prepaid expense gets credited. This is later. Prepaid expense gets credited. here the prepaid expense gets credited, and prepaid expense gets credited. Yeah, exactly, right. Chan, this is the expense is incurred on July the 1st, August the 1st, and September the 1st, because then they are using it. Very, very good. Yeah. Yeah. So and here we have the expense here. We have the expense here, and we have to debit it, and we credit the prepaid expense. Yeah. So this is here. This is July the 1st. When you debit prepaid expense and credit cash, and later you debit your expense and you credit your prepaid expense. Yeah. Here the prepaid expense, again, this is an asset for the company, because the company has the right to use the office. And here, unearned revenue, this is a liability. Think about the following scenarios. What is the key revenue issue? Think about these here. You go to a stamp, you go to a post office, and the company there sells you stamps. Let's say they sell you stamps today. When is the relevant revenue? Is it when the stamps are sold? Or do you think, is it when the delivery takes place? It's later. Revenue is when the delivery takes place. Exactly, yeah. Yeah, when the delivery takes place. When the service is performed or the product is delivered. When the delivery takes place. So not when the stamps are sold. The next one, concert tickets sold by a ticketing agency. We have concert tickets and they are sold by a ticketing agency. When does revenue take place? When the concert tickets are sold or when the concert takes place? What do you think? What do you mean, Sue, with a by customer? This is really the concert tickets. When the company sells concert tickets, then actually when when the concert takes place. Yeah, when the concert takes place, correct. When the concert takes place, the revenue is booked, is recorded. The next one, course fees paid to a university. Yeah, so there are students and they are paying fees to a university, and then later, let's say later, the courses take place. When is revenue recorded by the university? When the course fees are paid, or when the courses take place? When the courses take place, yeah? When the courses take place, before it's an unearned revenue, yeah? Again, unearned revenue. Next one, gift vouchers sold by a retailer. Yeah, think about, I don't know, Starbucks, yeah? And you go to Starbucks and you buy a gift card. You buy a gift card. When is the revenue recorded? When you buy the when the customer buys the gift card, or when the coffee is handed over? When the coffees. This is also this is important. Yeah, these are all examples of unearned revenue. So all examples of unearned revenue. The revenue is unearned unless the related product is delivered or the service is performed. Yeah, before it's only about money, but it's not about revenues. Yeah. So accrual accounting differs substantially from cash accounting, and there are two different specific areas. One is called deferrals. One is called deferrals. And the other is called accruals. And deferrals means something is paid in advance. Yeah, so this is paid in advance. This is paid in advance. Paid in advance, sorry. So for example, prepaid expense. With a prepaid expense, a company has prepaid an expense, yeah, and then it has the right to use the asset, yeah. Prepaid rent, for example. Then the company has the right to use the real estate, yeah. Unearned revenues is also paid in advance. It's paid in advance not by the company, as is the case with prepaid expense, but it is paid in advance by the customer. Concert tickets paid in advance is unearned revenues for the company. Yeah, so this is paid in advance, and accrued means essentially paid later. And there are accrued expenses and accrued revenues. Yeah, accrued expenses means you have an expense, but you pay later. Yeah, for example, accrued salary. Yeah, accrued salary payment. You have the expense now, but you cannot pay for the salary completely, and that's why it's an accrued expense. Or accrued revenues. Any idea what accrued revenues is? Another name for accrued revenues? Accrued revenues, salaries. Yeah, I would say accrued expenses are salaries because salaries are expenses by the company, and when they are paid later, then it is accrued expenses. Yeah, accrued revenues are, for example, accounts receivable. Because here the company has earned the revenue, but the money has not yet been flown. So the company knows that the company will the money will very likely flow, that it has already been earned. This is an account receivable. And whenever we're talking about depreciation of property, plant, equipment, we are also in the area of accrual accounting. Why? Because here we have an outflow of cash in the beginning. Yeah, and we buy something, we make an equipment, have expenditure, and when it is depreciated over time, that means that the expense booked. Yeah. So here we have an outflow first, and we buy the property, plant, equipment, and the expense is spread over the lifetime. Yeah, it's the expense called depreciation. Okay. All right. So let's do right here. Let's do a break here. Let's say break for 15 minutes, and then we continue.